Ladies and gentlemen, welcome to the video presentation of the module on source of venture capital financing. And this is Dr. S. Guruswamy, Professor and Head Department of Commerce, University of Madras. I have all pleasure once again to welcome for this video presentation. Before we go learn about the different source of venture capital financing, I would like to touch upon an important aspect relating to the source of venture capital financing, namely how to go about analyzing the venture capital proposals. A venture capitalist considers the following factors before committing the funds. Number one, fundamental analysis. According to Boyd-Chris, fundamental analysis refers to an examination of the fundamental aspects of the business without which the investor cannot even begin to make an informed decision. As part of the fundamental analysis, the following factors are considered. Number one, history. A brief history of the company, including the date of incorporation and a summary of progress is to be considered before analyzing or before providing the financial assistance. Number two, the management, the quality, experience, strategy and motivations of management, directors and existing shareholders must also be considered before providing financial assistance. Number three, products. A complete description of the company's products and services should be examined. And four, markets. The markets which the company serves, including the size and the nature of the industry, location and characteristics of customer base, potential competition and unique selling points should also be considered. Next is manufacturing. So, when it comes to making the fundamental analysis, it is important on the part of the venture capital company to take into consideration the kinds of the manufacturing processes which are put in place. So, the manufacturing and operational aspects of the business, including a description of the technology used, access to source of supply, manufacturing capacity and the premises owned or occupied must be examined. Then the risk. Undoubtedly, it is the risk which is more important when it comes to extending financial assistance to a new company or a new startup. So, the venture capital companies will consider as part of the fundamental analysis the objective analysis of the fundamental risks and the management plans to cope with the same. The next is the financial analysis. The purpose of financial analysis is to set out the financial implications of a company's strategy and to measure its performance. Following aspects are considered by a venture capital company in order to determine the financial stability, financial viability of the investee company. One, earnings potential growth. Number two, sensitivity of earnings to sales and margins. Number three, likely time lag between investment and return. Four, likely impact on cash flow. Five, expected value of the company at the notional time of divestment. Number six, analysis of the financial risks and management plans to cope with this. The next is the portfolio analysis. A venture capital company, before committing funds, also takes a look at the portfolio characteristic feature of the investee company, and that is what is called the portfolio analysis. Portfolio analysis consists in examining the venture capitalist portfolio balance at the time of making the investment, at the time of committing the funds or at the time of considering the investment proposal. Accordingly, the proposed investment must be an acceptable addition to the venture capitalist portfolio in terms of its size, its stage of development, its geographic location and its industry sector. And the following aspects are considered in this connection. As part of the portfolio investment analysis, the venture capital companies consider the following points. First, the size of investment. The amount of money per investment has a significant bearing and impact on the size of the portfolio. Moreover, if the venture capitalist builds up a very sizable large portfolio, hands-on management will be difficult. Second, stage of development. Your venture capital portfolio will typically consist of some companies which are in the startup phase, some companies in the development stage, and some other companies in the mature phase of its life cycle, such as MBO investment, which is the management buyout investment. The third aspect which is considered as part of the portfolio analysis by the venture capital companies is the geographical location. This is an important consideration. In order to reach an acceptable level of portfolio diversity and volume, many funds will go in for searching the foreign investments. The basic principle of a successful international investment policy is to join a syndicate with a local fund, which will have a superior understanding of the market and also the social, investment and tax environment. Fourth important aspect which is considered as part of the analysis, portfolio analysis, is the industry sector. This is the fourth factor in the portfolio diversification. Venture capitalist attempts to diversify the portfolio in order to offset the problematic or slow growth investments. Then the last type of analysis which is examined or which is taken up by the venture capital funds is the divestment analysis. Divestment calls for venture capitalists to have a clear idea about the method, the timing and the valuation of the company upon divestment. There are four principal methods and means by which venture capitalists realize their investments. These are: number one, trade sale. The process of selling the investment to a company in the trade, that is, a competitor wishing to buy the investee's market share or production capacity, a supplier intending to integrate forward, or a customer trying to integrate backward or tie up the source of supply, is referred to as trade sale. A trade sale is in the form of an unexpected and unsolicited bid. The second method of divestment is takeout. This is the process of selling the investment to another professional investor, another venture capitalist for that matter, by way of private placement with a major institutional investor such as an insurance company or a pension fund manager, or to a management holding company. Under this kind of an arrangement, typically only the venture capital company will sell the shares while the entrepreneur retain his stake. The third method of divestment is earn-out. In this method, the venture capital investment is realized through the entrepreneur buying back the venture capitalist shares with the proceeds of the project. For this purpose, the entrepreneur is given an option at the time of investment. The last method of divestment, which is usually adopted by the new companies, new technology companies, is flotation. This is the final exit route adopted by the venture capital investment funds. Under this method, the issue of securities is made in the stock market. In order to float, the company must have a good and complete management team. The methods of flotation will vary depending upon the circumstances. The usual methods are: 1. Placing, where a company's shares are placed with pre-arranged buyers. Offer for sale. This happens where a company invites the public to subscribe to its shares at a fixed price, which is underwritten. Third is the tender method, where the public is invited to name the number of shares and the price it will pay, with a minimum price being underwritten. Now, we will have a look at, after having learned what are the methods that we have in order to analyze, in order to examine the desirability of making an investment in a company, in a new company, we will take some time and then try to understand what are buyouts. Buyouts are a recent addition to the services provided by merchant bankers and savings institutions, and a new form of investment in the European venture capital industry. US banks first launched the concept of buyout already in practice in the US during the recession in the late 60s and 70s. And there are advantages which are claimed by this type of buyouts. And buyouts are popular among the investment managers for a variety of reasons, because they provide a lot of advantages. Let us now look at the various advantages emanating from these buyouts. First and the foremost, it enables and makes it possible lowering the investment risk, which is an important consideration. And then it also makes it possible to ensure there is a growth of small enterprises. Apart from that, it also helps promote the industrial deconcentration and then owner managed concept of business. It also enables development of new entrepreneur. It ensures management commitment, motivation and drive. In addition, it also helps ensure good personal relationship. Apart from that, it also makes it possible the facilitation of the importation of technological knowledge, problem solving devices, etc. It promotes better industrial relations. It ensures enhanced management performance. It provides for balanced mix of talents to achieve optimal results and productive efficiency. In addition to these advantages, it also facilitates the management buyouts. I mean, a revenue earning objective is implemented from the first day in order to generate cash and liquid assets in order to meet the cost of borrowings and for the purpose of making profits. Now, while exercising the option of buyouts, although we do have certain advantages derived by means of buyouts, we have to take certain precautions. The venture capital companies must consider taking some precautions in order to make the buyouts more effective and efficient. First and the foremost is that it is important that the conflict between the management teams is avoided. And then if there is going to be excessive debt generating capacity, that must be reduced. Then adequacy and conducive atmosphere in the management team for the buyout enterprise must be ensured. Pre-investment market survey to locate potential markets in order to ensure an adequate market share must also be ensured. Apart from that, it is important that the companies ensure what is called the sufficiency of cash availability. Now, in the case of buyouts, we have three different types of buyouts. One is management buyout, shareholder buyout is second one, and receivership buyout is the third one. Coming to the management buyouts, also known as corporate sale buyouts, are a type of buyout whereby existing entrepreneurs transfer the controlling interest to another company or another entrepreneur. The buyout usually involves 100% sale of the total business. It may also be a partial or complete divestment, where the original promoter may retain either a minority interest or none at all in the enterprise. Management buyout may also be for a subsidiary division or operating in different form, such as business entity or product names. Corporate sale buyouts are preferred in circumstances where the unit is unprofitable but could be rendered profitable through a buyout process. The unit is subsidiary to the core activity and is required to be separated from it in order to concentrate on the core activity. This way, the management resources have greater opportunity cost elsewhere with the post-merger rationalization of unwanted activity. Management buyouts will have different forms, essentially two types of forms. One is a small scale corporate sale, other one is the large scale corporate sale. Now, coming to the small scale corporate sale, This comprises of debt-based small-scale buyouts, equity-based small-scale buyout, and deferred considerations buyout. The management team of the company may acquire the business from its parent company at an agreed value. Debt-based small-scale buyouts have a higher proportion of debt included in the deal of assets, where realization within a short period is possible in order to repay the debt from asset surplus. Equity-based small-scale buyouts, on the other hand, assume no assets disposal at all, and the investor may take the equity base as equal to management. In the deferred considerations buyout, the vendor may have a part of the consideration money at no interest rate for several years, and the external debt element in the structure can be reduced. The second is large scale corporate buyouts. These are larger buyouts and are syndicated by several investors. The second important form of management buyout is the shareholder buyout. Share repurchase involves the existing management team buying out the controlling holdings from the original promoters who wish to retire from the management. This is done with the help of venture capitalists who supply the required funds. Receivership buyout. The third component of the management buyout is receivership buyout. It resembles to startup financing. A new company is formed to take on the assets and trading names of the group. The capitalization of the new company depends partly on the valuation of assets being acquired from the receiver at a discount. Now, let us look at the financial resources that are available to the venture capital companies. Venture capitalists in India, those who provide venture capital, in addition to using their own funds, make use of funds drawn from other sources such as All India financial institutions, foreign institutional investors, multilateral development agencies, foreign investors, private sector banks, public sector banks, state financial corporations, insurance companies, mutual funds, and so on and so forth. Some of the debt instruments used for venture capital financing include income notes, non-convertible debentures, partly convertible debentures, fully convertible debentures, zero interest bonds, secured premium notes, deep discount bonds, masala bonds, etc. Now, we will take a look at what is called investment nurturing, an important component of the source of funding which is required for the venture capital companies. Now, what is this investment nurturing? The process by which venture capital companies continue to involve themselves in the operations of concerns assisted by them is called investment nurturing. There is an enduring relationship of after funding care between the venture capital companies and the units assisted by them. Now, let us look at the objectives of investment nurturing. What are the purposes for which this investment nurturing is taken up? First and the foremost, ensuring proper utilization of assistance provided. Any deviation from the program's appraisal should be with the prior approval of the venture capital funds. Number 2, ensuring the implementation of the project or the venture within the time and cost envisaged. Third one, assisting in finding additional or supplementary finance in case of time and cost overruns beyond the control of venture capital funds. Fourth, providing strategic inputs in technology, production, finance, marketing, personnel, and so on. Fifth, anticipating likely problems and advising preventive or remedial actions accordingly. Sixth one, ensuring that the venture does not default in any statutory or other obligations. Seventhly, evaluating the performance of the project and suggesting measures for improvement if required. Then eighthly, making use of the feedback received during the course of nurturing the investment to study any problems and finding suitable solutions. Ninthly, utilizing past experience for better appraisal of new projects. When it comes to nurturing, investment nurturing we call it, there are certain elements which go into the making of investment nurturing. What are they? Let us have a look at them. 1. Provision of continuing guidance and support to optimize the benefits of investment to both the venture capital companies and the units concerned. Second, building a joint relationship to tackle operational and other problems of businesses. Third, protection of the investment or the interest of the venture capitalist. Now, after having learned what is this investment nurturing, let us go learn something called styles of investment nurturing. What are the different styles of investment nurturing we have? The extent of participation by the venture capital companies in the affairs of assisted units constitutes the style of nurturing. The style depends upon a variety of factors such as the specialization of the venture capital company, the stage of investment, financing plan, the stage of development of the venture capital industry, etc. The different categories of styles that are adopted for venture financing are as follows. Number 1, hands-on nurturing. Continuous and constant involvement in the operations of the investee company by way of representation on the board of directors is referred to as hands-on nurturing. Venture capital companies provide useful guidance on aspects of long-term business planning, technology, development, financial planning, marketing strategy, etc. to the units assisted by them. It is an essential style of financing in the early stage of the project. This type of care is provided either by the in-house expertise or by a core group of external advisors or experts in the specific areas. The second style of venture financing is hands-off nurturing. First one is hands-on nurturing, this one is hands-off nurturing. According to the style of nurturing, venture capital companies do not take part in the appointment of nominee directors on the board of assisted firms. The venture capitalists do not normally actively participate in formulating strategies and policy matters, in spite of the right to do so. The type of nurturing style is appropriate in case of syndicated, joint or consortium venture financing. The hands-off style may also be appropriate after the initial plan of the venture is over and the business is running smoothly. The next style of nurturing, we call it as hands-holding nurturing, hands-on nurturing, hands-off nurturing, and third one is the hands-holding nurturing. In this style of nurturing, the venture capital companies take part in the management of the ventures only when they are approached by the investee companies or the units. Venture capitalists provide either in-house assistance or arrange assistance from outside experts. Nurturing methods. Now, having learned what are the styles of nurturing, we will now take a look at nurturing methods. Venture capital companies adopt different methods, several methods to elicit information in order to carry out the job of nurturing the assisted units, and some of the important nurturing methods we will discuss. First and the foremost is panel discussion. In order to be able to assist the investee companies in an effective manner, venture capital companies collect information through personal, informal discussion with the entrepreneurs. The information so collected will provide the most comprehensive and effective insight into the working of the venture. This technique is especially useful when the company is facing operational problems. The next is plant visit. It is important that plant visits are undertaken by venture capital companies in order to collect first-hand information. For ventures which are at the implementation stage, the purpose of a plant visit is to review the progress of the implementation of the project, to see that adequate and well qualified personnel have been appointed for the implementation of the venture. To ensure that the required sanctions for are obtained for funds from other sources, and if necessary to ask if the venture capital has initiated action for obtaining the working capital from banks. In addition, plant visits also help examine aspects such as the staffing pattern of production, marketing, finance, personnel departments, operational performance of the project, marketing aspects with special reference to product acceptance, market penetration, distribution, pricing, product awareness, advertising, competition, and so on. The next is the feedback. The next nurturing method is feedback. Venture capital companies also collect information through the nominee directors. The nominee directors, in addition to protecting the interest of venture capital companies, contribute effectively and efficiently to management by providing the requisite guidance. They also ensure that business is run on sound basis. The nominee directors should therefore have good exposure to industry, have good knowledge, adequate knowledge and about technological developments, changes in consumer policies, financial management, laws, regulations, and so on. The fourth important method which is used for nurturing is periodic reports. Information about the operations of the units that have been assisted also collected by the venture capital companies through periodic reports. The results are then analyzed and compared with the projected performance, and follow-up action is accordingly initiated. Now, coming to the next part, we have something called commissioned studies. These constitute special studies conducted in order to identify problems and offer solutions so that preventive action can be taken. These are undertaken when the venture capitalists lack experience and face difficulties in nurturing. Coming to the compensation which is available to the venture capital companies, the mode of compensation to venture capitalists is determined before undertaking the venture financing. In general, a venture capital company is paid compensation in the form of an annual management fee. This covers the normal operating expenses such as salaries and allowances of employees, administrative expenses and all expenses related to the selection of investments as well as divestment, but excludes legal expenses and professional fee relating to the investment profile, which are reimbursed separately. It is generally 2 to 3% of the net asset value on the capital of the fund. Forms of organization. A typical venture capital company is organized in different types of forms. One is the most prominent one is the limited liability partnership. This is an important form of organization. Next is the investment company. Invariably, the the venture capital companies do go for investment company as a model, which is a simple form of organization for venture capital companies. The investment company manages the portfolio of its investments in a wide range of undertakings. Another important model is investment trust. Being in the nature of a trust, it is generally not liable to pay taxes on chargeable gains or dividends. However, its other incomes are taxable. The availability of tax concessions is subject to stipulations that the fact that income should be derived wholly or mainly from the investment in shares and securities holding in any single company other than another company trust should not exceed 15% of the value of the investment. Next model is the offshore investment company. Another form of organization of the venture capital companies is offshore investment company. A company which is incorporated in a country other than the country in which the offshore company makes an investment is known as offshore investment company. Its tax liability depends on the tax laws applicable to the resident status of this company. The next is offshore unit trust. The next is small business investment company. And this type of organization is followed by banks which participate in ventures in the form of equity and long-term debt. They are prohibited from investing more than 20% of their capital and reserves. Similarly, they are not allowed to acquire controlling interest in a single company. The loans must be for not more than 5 years, and this is very flexible structure for equity investment. Exit mechanism. Every venture capitalist usually liquidates, or every venture capital investment is liquidated after the accomplishment of the purpose of the venture investment. Capital gains are usually made by the venture capitalist since they are in a position to sell their units at a fabulous price in the capital market. The time of exiting is decided in advance, sometimes even at the time of financing the venture companies. Several factors are taken into account before deciding the exit, such as the nature of the venture, the extent and the type of financial stake, the state of actual and potential competition, market condition, etc., etc. The usual methods which are adopted for the purpose is the IPO method is the most popular method of exiting mechanism adopted by the venture capital companies. Now, let us learn more about this IPO method. IPO method, also known as initial public offering method or going public method or flotation method, is a method of exiting adopted by venture capital company whereby the exiting takes place through a public issue of capital. It is the most popular exit route. The chief advantage of this method is that it facilitates liquidity of investments through listing on stock exchanges. Besides, the method commands benefits such as higher price of securities as compared to private placement, better image and credibility with the public, managers, customers and financial institutions. An important requirement for venture companies resorting to this method is the adoption of reporting requirements, stock exchange regulations, and then you have disclosure requirements, etc. The chief drawback of this method is the higher issue cost, increased accountability to shareholders, etc. Venture capitalists can also approach OTCI as a public issue for exiting, whereby bought out deals are struck with the members of the OTCI, who would in turn offer the shares thus acquired to the public at a future date. You also have methods such as sale of shares, puts and calls method, trade sales, and finally the liquidation. Liquidation happens by the venture capital companies liquidating the very venture itself. The exit takes place in an involuntary manner. This usually happens under circumstances where the technology or failure happens. As regards the debt instrument, the exit takes place only at the end of the loan period. And ladies and gentlemen, we have had and we had a wonderful discussion. I believe you would have learned the different sources of venture capital financing, and I thank you for watching this video presentation and wish you good luck. Thanks a lot.